The first STX-based tool to mention here is the triple STX with shadow, which is currently being shown on the chart. As you can see, it plots on the price bars themselves and offers three different methods of STX stop calculations as well as the shadow line. That is, you have available to you a fast STX shown here in orange, as well as a medium speed STX or regular STX shown in cyan, and finally a slow STX shown in the darker blue. The STX plots in this study can assist in the identification of both trend changes and trend strength conditions of the market. For instance, trend changes might be picked up by virtue of prices crossing from below to above all three of the STXs, and by virtue of the STXs themselves crossing one another, getting into this bullish fan formation in this location here. Conversely, the alternative of that going into a bearish phase would be prices cracking through the fast STX, which in turn then have prices dropping below the regular STX and ultimately below the slow STX, indicating a change in trend. And then the STXs themselves will juxtapose and change position as well. The fan then remains in effect all the way into the low, and ultimately the exact same scenario that we saw earlier there in 2007 takes place here in early 2009. That is, prices crossing from below to above all three of the STXs, which in turn then, if the strength of the move is powerful enough, will force the STXs themselves back above one another, and you get into this bullish fan formation. In addition to that, it can assist in the detection of terminations of reaction points. That is, locations where the fast STX pulls back to the regular STX, and or in some cases the regular STX can pull back to the slow STX. At any rate, price penetrations of one or two or all three of the STXs is another way to identify these reaction points, such as here, 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 and so on. In addition to that, the triple STX can offer you three different and very powerful and accurate methods of stop placement. That is, under certain scenarios, given the messages being provided by other ocean-based tools, one might choose to revert to, say for instance, the fast STX in a location like this to take you out of a trade much nearer the high of this particular move than the regular STX would. And then, of course, the penetration gives you an opportunity to re-enter should the market take back off in the trend strength direction again. The shadow line, then, which is shown here as the dashed line that rides in a bullish phase above the triple STX or below the triple STX in a bearish phase, can further refine the accuracy of reaction points by virtue of it pulling back into the triple STXs themselves. In a case like this, where the shadow comes down, finds this conjunction at a location where the fast and regular STX are, same scenario here, basically same scenario here, here, and here as well. And it can also help you identify turning points in the market by virtue of very sharp angular turns that it may make as prices themselves are making a turn as well, such as here, 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 down at the bottom, up here at this top as well. All of the locations, by the way, marked on this chart are based on patterns and rules to be used with the triple STX, and these are explored in much more detail in the triple STX video. Now let's take a look at another of the STX-based tools, that is the component 4 line. Here we see the STX-based component 4 line, shown in this pane immediately below prices, which in addition to helping define trend direction and strength, and by the way, trend direction and strength can be identified by virtue of the location of any of the three oscillators related to the component 4 line. And by the way, it's known as the component 4 line because the 0 line in effect constitutes the fourth line. The location of those relative to the 0 line here is instrumental in determining trend. Obviously, the fast will cross from below to above the regular and slow, which in turn then will pull them higher, and as long as they reside above the 0 line, we're considered in a bullish phase, When they cross below one another and below the zero line, we're in a bearish phase. And then once again, if the market turns and they fan back out in the other direction, we're looking for these crossovers as well. Trend strength then is identified by the relative positions of them. In bullish phases is the fast above the regular, which in turn is stacked above the slow. And conversely, in bearish phases is the fan operative in terms of the fast being below the regular, which in turn is below the slow. They can also be instrumental in identifying overbought and oversold conditions. That is, we have an overbought condition here by virtue of the fast being above its standard deviation band. Same in this zone here. These are in trend direction, by the way, because of the fan position. Same condition exists here and here as well. And they can help in identifying termination points of counter-trend reactions. That is, are they hitting the opposite standard deviation band or coming back into conjunction while the fan is indicative of either a bullish phase during this period, with a position like this being the terminus of a counter-trend reaction, as well as this one, and locations over here where that would be true would be this and this as well. It also can dramatically help us quantify the messages, both those that are blatant as well as those that are subtle, coming from the triple STX study that's shown above. By the way, for instance, we had mentioned the one-bar penetrations here of the, in this case, fast or regular or slow of the STXs, and note that we're getting confirmatory information coming from our component 4 line in cases like that. A conjunction basically occurring here. We get the same scenario here where we get the penetrations, and we've got confirmatory evidence as a result of the component 4 line. All right, that's a brief understanding of the functionality of the component 4 line. Now let's look at the remaining STX-based oscillator, that is the STX number 7. Okay, in this bottom subgraph here, or pane in Trade Navigator as it's known, I've included the STX7, and by the way, I've simply left the triple STX on price as well as the component 4 line above so that we can see the interactions of those. This is an oscillator that's primarily used to help define the trend structure of the market, for instance, its location above or below zero, as well as those points where crossovers are actually occurring, and to quantify the degree of extremes that the market may be experiencing. For instance, if the oscillator is above zero yet hitting its lower standard deviation band, shown here and here, where with a minor penetration of the zero line, while that was not present from the component 4 line, it was indicative of a market more deeply oversold as measured by the STX7, but still in a very bullish phase by virtue of what the component 4 line was telling us. It also offers information concerning locations where the market is likely to become more volatile and potentially ballistic. That is, locations where, for instance, we are getting standard deviation band pinches, as in this zone right here, where basically the market took off in a final thrust in a very ballistic fashion. And note also that it's very good at picking up divergences in, though it is not momentum-based, it's in effect picking up a momentum-based divergence situation as we fall into this low, and tracking its location relative to its own centerline moving average can be instructive as well. And oftentimes what will happen is at a major important low, you'll see the STX7 cross from below to above its moving average and make another return to the moving average right here, for instance, signifying that we may be setting up a significant bottom. And of course, the confirmatory evidence then would come from information contained by, in this case, the triple STX as well as the ultimate crossovers that we were getting from the component 4 line. And of course, when this tool is used in conjunction with those, that is the triple STX and component 4 line, reading the behavior of the market can often be like reading the newspaper, and appropriate trading strategies then to capitalize on that information can be greatly simplified. Now that we've taken a brief cursory examination of the way both the triple STX with the shadow line and the component 4 line and the STX7 operate, let's examine the remaining Ocean Pro tools that are additions and enhancements to existing indicators in the Ocean library. Okay, we're now looking at a chart of TradeStation, and we see the NMC with SDs and MA studies, as well as the NMC2 with SD and MA study, and finally the NMS with SD and MA study. Note also that I have left the triple STX with the shadow line present on the price bars as well. And in this illustration, I've also added the regular ocean moving average with its ocean-based standard deviation bands to the price bars as well. Of course, the moving average is shown here as the thicker solid magenta line, and the standard deviation bands, in this case the lower band, shown with a dashed lower magenta line, and here the upper band as an upper dashed magenta line. Since it plots on the price bars along with the STXs, this addition adds yet another qualifier to the triple STX study, and as we'll see later, to the understanding of the behavior of most other ocean-based tools as well. Now, a thing to remember here is that the NMC and NMC2 studies are three of our primary zero-hit tools, with the NXC indicator being the final element in the trio and the subject of yet another video segment. Though they can perform several tasks, the NMC and NMC2 indicators are primarily designed to pinpoint the setup locations where terminations of counter-trend reactions are likely to form. For instance, locations like this right here where we have an NMC2 zero hit at a low with this triple STX formation that we were well aware of. Another example here where we have NMC hitting zero, and by the way, hitting its lower standard deviation band, which we previously could not see, that being confirmed by NMC2 also at its lower standard deviation, as well as NMS. And of course, the opposite of situation of that can take place as well. Here is a zero hit from below on a cross kiss for a sell setup, where we're hitting the upper standard deviation band. That too is being confirmed by the upper standard deviation band hit in the NMC2 as well as the NMS. Another example of that here would be a zero hit at this location right here from the NMC as well. Thing to remember here is that with our highly accurate entry techniques, we can usually isolate the entry setup, that is in a location like right here, to the high or low bar of the reaction. This then allows us to greatly minimize the initial risk that we have to assume, and with the ocean-based initial stop method that we teach, the risk is oftentimes limited to the range of a single bar, regardless of the time frame in question. Of course, the multiple time frame zero hit analysis that we also teach supplies us with methods to shoot for profit objectives coming from a higher time frame, while usually only requiring the risk structure of the range of a single bar based on the lower time frame. Again, it's important to note that both upper and lower standard deviation bands are continuously displayed on several of the indicators in this new ocean library, including the NMC, NMC2, and NMS studies shown here, upper band and lower band. This then allows us to identify new trade setup locations based on sound statistical information that we couldn't previously recognize. Also, with the inclusion of both the fast and regular ocean-based moving averages, shown here as thin, solid lines, in this case the fast being cyan and the slow being magenta, as well as the new center line emanating from the upper and lower standard deviation bands that bisect them, we now have waypoints to help determine support and resistance zones for the indicators that are often very different from support and resistance typically identified via moving averages on price. And here's a classic example of that, where we had no prices nowhere near the regular ocean moving average at this location, yet they were residing from the NMC2 and the NMS right on the ocean-based moving averages. As we'll see throughout this series, these can provide often hidden and extremely useful trade information at critical locations in the market.